It is earnings season, which means it's time to hand out some grades. And today we're giving a full report card to an industrial giant, Rockwell Automation. The numbers are in, and honestly, they tell a really fascinating story. Not just about one company, but about the health of the entire global economy. So, how in the world do you grade an $8 billion company? Well, we're going to treat this like a health checkup. We'll look at the vital signs, we'll check for any underlying conditions, and then we'll see what the prescription is for the year ahead. Okay, so let's jump right in. We're going to be breaking down Rockwell's fiscal 2025, taking a close look at their third quarter results and then zooming out to see that full year picture. And remember, these reports are so much more than just numbers on a page. They're really a window into the state of manufacturing, automation, and global supply chains. Now, just in case you're not familiar, Rockwell Automation is a huge player in the world of industrial tech. I mean, from car factories to life sciences labs, their hardware and software are basically the brains behind countless automated processes that pretty much shape our modern world. So our checkup is going to start with the third quarter. And right off the bat, the initial signs looked really positive. This kind of set the tone for what turned out to be a year of navigating some pretty serious economic challenges. The first vital sign we're checking, sales. And Q3 saw a healthy 5% growth compared to the year before. That's a really solid start, and it shows their steady demand for what they're selling. All right, next up, profitability. Their adjusted earnings per share, or EPS, came in at $2.82. Now, the crucial part here is that this number actually beat what analysts were expecting, which signals some very strong performance on the operational side. And this points to just incredible efficiency. The company managed to deliver $250 million in cost savings, and get this, they hit their target a full quarter ahead of schedule. That is a massive operational win. So, the initial diagnosis for Q3, a clean bill of health. We're talking solid growth, strong profits, and fantastic efficiency. But, to really understand the full picture, we've got to dig a little deeper and ask, where is all this growth actually coming from? So now we're getting into the nitty-gritty. We're going to break down their performance by business segment and by region to see which parts of the company were really firing on all cylinders and which ones were facing some headwinds. Okay, first, a real quick primer. Rockwell basically organizes its business around three types of industries. You've got discrete, which is all about making individual items. Think cars. Then there's process, for stuff made in bulk, like chemicals. And hybrid is, you guessed it, a mix of the two, like food and beverage production. The clear star of the third quarter was without a doubt the discrete segment. It surged by about 10%. And what was the driving force? A massive 30% jump in demand from e-commerce and warehouse automation. Yep, every time you shop online, companies like Rockwell are working behind the scenes to get those packages to your door faster. Now, on the flip side, the process segment, well, it faced some challenges, dipping by low single digits. This was mostly due to slowdowns in the mining and chemicals industries. It wasn't all bad news, though. The energy sector was a small but important bright spot. And this really shows you how a diversified business can help balance itself out. Okay, let's zoom out and look at the global picture. North America is clearly Rockwell's powerhouse. I mean, it accounts for a massive 63% of their total sales. This means that the performance of this market is absolutely critical to the company's overall health. And this regional breakdown, wow, it tells a powerful story. You've got that strong 7% growth in North America really driving the quarter. But then you contrast that with Latin America, which was down a significant 14%. This just highlights the really uneven global economic conditions Rockwell had to navigate. All right, so we've finished the initial checkup on Q3. Now it's time to zoom out and look at the complete diagnosis for the entire fiscal year. The big question is, how did these trends hold up over 12 months? This table gives us a fantastic side-by-side comparison. You can see right away that the strong organic sales growth from Q3 cooled off to a more modest 1% for the full year. But, and this is important, adjusted EPS growth actually accelerated for the full year, up 7%. And their recurring revenue finished strong too. So the key takeaway here is this. Even with slowing sales, they managed their profitability incredibly well. The company's CEO, Blake Moret, he summed it up perfectly. He basically said, look, we knew it would be a tough year, but he framed the results as them delivering on their promises. And honestly, based on those adjusted numbers, he's got a point. But here's where our story takes a little bit of a turn, because if we only looked at those adjusted numbers, we'd miss some really crucial details hiding just below the surface. So, was it all good news? Let's dig into the fine print. Okay, to understand this, we need to know the difference between two key terms. You've got diluted EPS, that's the official by-the-book profit number. Then you have adjusted EPS, which we've been looking at. That's a modified figure companies use to show their performance without what they consider to be one-time or unusual items. And in Rockwell's case, there were two pretty major one-time charges. First, a $136 million charge tied to old asbestos liabilities. And second, a $110 million charge from their decision to dissolve a joint venture they had called Sensia. These are significant items that hit the official bottom line, and they hit it hard. So what was the total impact of all this? A whopping $1.88 per share. That's the difference between that rosier adjusted profit and the official diluted profit. And that, my friends, is a huge piece of the full year story. So, after a year of mixed results and some pretty major financial housecleaning, what's the plan going forward? Let's take a look at Rockwell's treatment plan for the upcoming fiscal year 2026. Here is the game plan. First, they're projecting a rebound in sales growth, aiming for somewhere between 3 and 7%. Second, they're targeting a significant jump in that adjusted EPS number. And third, strategically, they're simplifying the whole business by getting rid of that Sensia joint venture, which should let them focus more on their core operations. It's a very clear three-part strategy for the year ahead. And that really brings us to our final question. Rockwell has faced the challenges of 2025 head-on. They made some tough but strategic decisions to clean up their books and simplify their structure. You know, the final grade for this year might be a B, for better than it looks on paper, but the real test is still to come. Can this new, more focused game plan actually deliver on its ambitious targets in 2026?